Good afternoon, everyone, and thanks for joining us for What Makes a Plan Qualified. I just have a few announcements for those of you who are requesting credit. Please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. So let's get started. We are joined today by Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoint on workplace retirement plans, plan design strategy, and retirement success and employee savings trends. Rich, let's start talking qualified retirement plans.
Lizzie, thanks for the introduction today. I appreciate that, and thank you, the attendees, for joining us this afternoon. I think we've got a pretty exciting topic here, which is really going to go back to what I would say are the beginning days of ERISA, back to the late 1970s when ERISA was passed, and really, ERISA became the foundation for what we know as qualified plans today. Lots have happened over the last almost 45 years since ERISA passed. Lots of changes and updates, but we're going to go through, I would say, the basics and probably a little bit more than the basics in terms of what makes a plan qualified. Some of the things that we're going to talk about this afternoon, we're going to go through the list. We're going to list the benefits of plan qualification, differentiate between different types of plan documents, which, in our world they're known as prototype documents or custom plan documents, or individually designed is another way of saying the same thing. So there's kind of a big spread of options available depending upon which type of plan document is used to establish and maintain a qualified plan. We're going to go through an understanding of the basic plan provisions, those that are optional provisions, at the adopting employer or plan sponsor level, as well as a lot of the rules and regulations that are mandated under the current law. We're going to go through various plan types, which I think is interesting because not everybody gets exposure to the various types of plans that are available in the marketplace today. Plus, we're going to dovetail that into the various types of entities that can sponsor various types of plans, which, again, I find fascinating that there's differences between, and we'll get into it a little bit later, governmental plans or private industry plans, state plans, so on and so forth. And we'll kind of wrap up the discussion today with an overview of maximum contribution limits and salary limits and various other limits that impact qualified plans, which, as many of you would know, that when certain plans have participants who are bumping up against certain plan limitations, what we're going to find is non-qualified plans are potentially a solution to that. So that's kind of the high-level overview of what we're going to do this afternoon. So we're going to jump right in and talk about some of the things that plans need to meet or do in order to be qualified. Number one, in order to maintain that plan for their employees and for those contributions to be tax deductible for the plan sponsor. Tax deductibility is another kind of an interesting topic because various not-for-profit or non-tax entities can also sponsor qualified plans, even though they're not getting a tax deduction per se for any contributions that plan sponsor may be making to the plan. But, I think one of the basic premises of a qualified plan is that taxation of benefits is deferred until those benefits or those contributions or those accounts are distributed to plan participants. And that's clearly in contrast to most non-qualified plans, right, where plan sponsors typically do not get a tax deduction up front, and they only get a tax deduction when those benefits are paid to participants. And once non-qual benefits are taxable to participants, that's when the employer gets the tax break in a non-qualified plan. Again, we're not really going to spend much time at all on non-qualified plans, but thought it might be interesting just to point out some of the differences there. So one of the key elements of a qualified plan is, it's got to be in a written format. It's got to be in a plan document. And the plan document has to conform to law. It has to conform to rules and regulations set forth by the Department of Labor and or the Internal Revenue Service. And some of that language is, as I said earlier today, optional at the plan sponsor level, but some of it is required, by laws, rules, or regulations. So that's key, and we're going to get into it a little bit in terms of amending plan documents. Most plan documents need to be amended typically once every 5 years or so to bring them up to date with any laws and rules or regulations that may have changed in the interim. So there's kind of a restatement period that is cyclical out there for everybody. And then there are things that kind of crop up in the interim, some things like the CARES Act in March of 2020, that put in a whole bunch of, or made available, I should say, a whole bunch of optional in-service type distributions and or loan limits that were much higher than the norm at the beginning of the pandemic. So, in that specific legislation, what Congress said is, you've got until the end of the 2022 plan year to actually amend the plan. So, the amendment cycle, even though I said it's typically a 5-year restatement cycle, there could be interim optional amendments that are done. Again, we're going to get into this a little bit later, but there could also be some other mandated law changes like the CARES Act that would require those amendments to go into place along the way. So, overall, other than the plan being in a written format, which is known as the plan document, along with that, there's a shorter version provided to participants, an SPD, summary plan description, that's required to be distributed and given to all the participating employees. But then there's also compliance issues, right? So, for example, in 401k plans, there's average deferral percentage testing, and there's matching contribution testing, and but again, above and beyond that, there's a whole bunch of other operational compliance testing requirements that need to be done each year on a qualified plan. And I guess finally, and again, this is still really high-level stuff here, reporting and disclosure requirements, and that typically would come in the form of the annual Form 5500 filing. And there are some other additional requirements. We see a lot of plans that have employer securities in them, so there may be other types of reporting that certain public companies may need to do with a qualified plan that has employer securities as an investment option. So again, high level, plan's got to be written. It's got to conform to the law, the rules, the regs, and obviously it's got to be operated in compliance with that plan document, and again, certain reporting to government agencies get done. Interesting note, Form 5500 is deemed to be a filing with up to 3 different government agencies. It's always a report to the Department of Labor, DOL. It's always deemed to be a report to the Internal Revenue Service. And in the case of defined benefit plans, that 5500 filing is also a report to the PBGC, which is the Pension Benefit Guaranty Corp. So, a little bit interesting in terms of how that reporting gets done. So let's talk next about I didn't go too many slides here. Here we go. Loss of qualification. So not following rules can result in a plan not being qualified. Again, our discussion today is all around what makes a plan qualified. So, even if you hit the nail on most of those requirements that we just talked about, if the plan is not operated in compliance with the plan document, the qualified status of the plan could be in jeopardy. And what that means is pretty draconian results, right? The plan sponsor can lose tax deductions for any contributions they might have made. Benefits could become immediately taxable to participants, and there could be penalties assessed. So a couple of quick points on this. So, in my experience, I have not, I'm just trying to think carefully here, in my entire career, I've not seen a plan get disqualified by the IRS. Typically there's some way to fix, whatever might be broken, or whatever rule might have been violated. And unfortunately, there's typically penalties that go along with it. But again, in my experience, the IRS is a little bit reluctant to disqualify a plan because they realize that most qualified plans benefit, typical employees, right? Rank and file employees, non-highly compensated employee participants in these plans. And, to disqualify a plan and immediately have those benefits become taxable to all of the participants, as I said earlier, is a rather draconian effect. On the other hand, the IRS is less concerned about, let's say you had a plan that is covering only owner employees or highly compensated employees. I mean, they'll typically will take a harsher look at a plan like that because, but again, I've never seen any of those disqualified either in my entire lifetime. So it's a threat that hangs out there. But I think the real issue is to just make sure that you're on top of managing the plan properly, doing amendments timely, complying with law. One of the questions I get all the time is, there are potentially some gray areas, for example, in plan documents. Well, what does that really mean and how does it work? And, whoever the responsible fiduciary is for the plan, I'm not going to go too deep into fiduciary today, but, there's something called an ERISA 402A named fiduciary for a plan. And that, fiduciary or could be one or more, by the way, fiduciaries has ultimate responsibility. But ultimately, it all leads back to the plan sponsor who may have appointed that fiduciary of the plan, that named fiduciary. But again, in many cases, for many plans, it's the employer who's the named fiduciary anyway. So, a lot of responsibility at that level. There's also an ERISA 316 plan administration fiduciary that is charged with certain tasks. And a lot of plans these days, that fiduciary is also the plan sponsor, right? So, it's critically important to make sure that the plan is administered properly in accordance with everything that's in the plan document. And I, frequently get questions like, well, how do we handle a certain, whether it's a transaction or, processing maybe a loan or a hardship or something like that. And, my first response is, well, let's see what the plan document says, right? There are certain things that are baked into the law that there really is no wiggle room, but in many, many cases, and I'll just pick on hardship, for example, there are certain statutory hardships, there's about 5 of them or 6 of them that are pretty typical, but they don't all need to be baked into the plan document, right? A plan sponsor does not, for example, have to permit hardship distributions from a defined contribution plan. We have other plan sponsors who, only permit hardships in 1 or 2 of the 5 or 6 different choices. So again, first step is if anybody is unsure about what to do, I always say go back to the plan document, let's see what that document says, and let's move on from there. And if the document isn't accomplishing, right, what the need is, it's possible, if there's flexibility in that provision, to amend the plan document on a go-forward basis and make it more effective for plan participants or for the needs of the employer. So Plan document is kind of the guiding light of how the plan should be administered. Penalties, it's worth spending a couple of minutes on penalties today. Penalties went up dramatically in the last 2 years or so. Secure Act was passed in the December of 2019, and there was a whole host of additional increases in penalties, things like failure to file a 5500 form timely, penalties that were like $25 a day with a $25,000 cap have now changed to like 10 times that amount, $250 a day with an enormous cap. So, and I think that was really Congress's way of providing a revenue source, right? Congress always typically looks to balance budgets, and if they're giving tax breaks through law changes that impact retirement plans, typically they need some way of recouping some revenue, at least on paper, for budget purposes. So again, following the plan document is critical to avoid problems and issues down the road. So again, a couple of basic qualification rules. Plan document language has to be up to date and correct. Plan language must be followed in actual operation. We said that a minute ago, and failure to follow those rules could result in loss of qualification, which could have bad tax consequences for the adopting employer and for the participants. But again, it almost, in my experience, never really gets to that third bullet on this page, because the IRS or the DOL will typically force a correction of some sort and also apply a penalty that is paid by the company. And I'm not here giving tax advice today, but typically those penalties are not tax deductible items for the plan sponsor. So critically important to follow the plan. Kind of an interesting example, many years ago, I had come across a plan that had a 10-year cliff vesting schedule. And if you can imagine, it was literally a couple of decades ago. And that plan actually had an IRS determination letter that said the plan was qualified in operation and the language was, up to snuff. And that plan was audited. And the IRS agent challenged that and said, you didn't comply. The plan sponsor didn't comply with the then current vesting max, which said, you could either have had at that time, I think, a graded schedule up to 7 years or a 5-year cliff, not a 10-year cliff. And, good news, bad news, right? We were able to successfully defend the client, right? Because the IRS issued a determination letter that the plan was qualified in form and substance. And, but they did make the plan sponsor change vesting on a go-forward basis. So I always say the plan language matters. The plan language counts. The plan language is supposed to comply with law, but there was one crazy instance where that plan had applied for a determination letter, and it must have just crossed over a law change of some sort, and they sanctioned it. And I guess it's a good news, right, that we're able to defend it. But that's why we always say it's critically important to be in compliance with current law. Let me move on one more slide here. Plan amendments. They come from a couple of different sources. As we said before, when laws change, plan documents are usually required to be amended to comply with that change, and that, to formally put that language in the plan document. And typically that gets, I'll call it, cleaned up, right? On the these days, it's basically a 5-year restatement cycle. But again, the IRS or the DOL may make plan sponsors adopt certain interim amendments, just to at least sign a piece of paper that, acknowledges that plan sponsor has adopted the feature, if it's an optional feature, by the way. Not untypical. It is typical that there'd be an interim amendment, and in a lot of cases, the IRS and the DOL will actually give service providers relatively standardized language that can be adopted and used en masse with various clients that they might be servicing. So law changes are out there. IRS regulations and DOL rulemaking comes up. Certainly in the last couple of years, it's been almost nonstop with some new regulation or interpretation of the law. And a lot of times those features are mandated. One relatively recent example, I think it was in the summer of 2021, August or September or so, IRS came up with language on, actually it was the Department of Labor, came up with language that said, hey, you've actually got to show a lifetime income number on benefit statements at least once a year. And they issued proposed rulemaking on it. And with proposed rulemaking, there's always a comment period, typically 60 days or maybe 90 days in some cases for the industry to provide them with comments. And then they come up with a final rulemaking, which they did, I think, in October of that year. And they basically said, you've got 12 months from the end of September 2020 to get lifetime income disclosures on participant benefit statements. So, that's one where the clock is kind of ticking, because if you look at the math on it or the calendar on it, that has to be on a statement no later than June 30th of this year. If you want to, again, there's one of those optional things. If you want to be afforded protection with a safe harbor that they had provided in those rules. So things like that come up, and it's important to work with a firm that's helping you service the plan, that knows the rules, knows the timing, knows how to get things done, and knows how to advise clients properly in terms of what to put in the plan and what not to put in the plan, and how to meet the various government requirements over time. So keeping documents up to date is critically important. That's one thing that we always do when we take on a plan that's new to us. Maybe it's been around for a while, serviced by somebody else. We kind of go through everything and make sure everything is up to date. It's kind of an audit, if you will, of how that plan's been operating to make sure it's in good order before it comes on board. So I think we've got, is this our first question here, Lizzie, for the group?
Yes, it is our first polling question, and it's going to appear on your screen shortly. The poll is now open, and it will be open for about 45 seconds to a minute.
So, as you go through this list, take a look at what you think, what items a plan has to satisfy to receive favorable tax treatment. And again, that's what we're talking about this afternoon. Qualified plans, what makes a plan qualified?
This poll will be open for about another 15 seconds for all of you who have not chosen an answer yet. All right, the poll is now closed, and you can continue, Rich.
All right. Are the results showing here or no?
No, they do not.
All right. Did you get reporting on it, or did most people get it right? I guess is my question. Or is that something we look at later?
We'll look at that later, but the majority did get it correct.
Okay. All right. Perfect. Thank you. Okay. So in terms of the summary, some of what we talked about here, maintaining qualification is critically important to maintain that tax status of the plan, to keep contributions that have been made deductible at the employer, plan sponsor, or participant level if it's a 401k type plan, and to make sure that taxation of those benefits are deferred. Again, plan document, plan language is critically important. And making sure those plan documents are up to date is also a critically important thing. So we'll talk next about mandatory plan language. ERISA has certain language that is designed to protect participants. So you can see from the list on the screen, plans have to have language that addresses who are the named fiduciaries of the plan, what are the funding procedures. It has to go through in detail operations and administration, and just simple things like eligibility. We see a variety of eligibility requirements. There are plans that have a 1 month waiting period, and participants enter on the first of the month following the 1 month, and from which they've been employed. Others may have quarterly or semi-annual or annual eligibility requirements. So it's usually not too confusing. Obviously, once that's set and the plan sponsor understands how it works, it typically is pretty smooth. But if there's not a clear understanding of how eligibility works, you can have two impacts. Number one, you could potentially enroll participants in a 401k plan, let's say, before they're eligible, which is no good. And likewise, you could have something that's probably even worse, which is a failure to enroll participants timely. And again, there's obviously correction methods out there to fix both of those, but not enrolling participants timely is particularly painful for plan sponsors because you basically have to go back and make up some of the matching contributions that those people otherwise could have, would have, should have gotten had they participated on time, and potentially making up earnings that they would have gotten on those accounts for the period that they were not enrolled properly. So again, that's just one quick example. Distribution procedures is another thing that we see some gaps on. I mentioned the hardship scenario earlier. We've seen plan sponsors think that certain events were, hardships eligible under the law, and in fact they were not. So again, any of these things that from an administrative procedure potentially puts the plan at risk. But again, as I say, a good third-party administrator or an ERISA 316 fiduciary, if you've outsourced that function for that plan, will catch those items and work with the plan sponsor to correct anything that might be deficient. Plan documents also spell out participants' rights. And again, the SPD, Summary Plan Description, is a supposedly short version of the plan document. I've seen those run anywhere from 15 to 30 pages in length. And if you think that's simple, that is supposedly simple. But more important than that, if a participant has an issue with respect to anything in that plan, certainly at a high level, it's going to be covered in the SPD. So that's a useful document for all the participants. But one of the things that the plan document, as well as the SPD, has to point out, not only pointing out participant rights, but has to outline the process to appeal denial of plan benefits. And again, I'm not going to go in depth on that today, but there are certain rules that participants must follow in terms of timing of making those claims for benefits. Similarly, plan sponsors need to respond within very specific timeframes, otherwise they can be subject to sanctions and penalties. So we're going to talk next about who can require plan changes. We've talked about some of these already. Congress can change the tax law like they did in ERISA, by the way, which they did with the Secure Act back in December of 2019, and that body of law was massive. Gosh, I don't remember how many pages that was, but it was enormous. And a lot of things changed. Some were mandatory, some were optional. And that definitely can change the language that's embedded in the plan, and that can either require interim amendments or amendments on that cyclical plan document restatement period. So, and again, IRS and DOL can change rules and regulations in the interim. That also changes plan language, changes the operation of the plan. And again, amendments may be required. And that best example I gave you earlier was the CARES Act. Does require certain amendments to be done by the end of 2022, even though they were adopted back in March or as early as March, late March of 2020. So again, from our standpoint, this is pretty typical stuff. But for plan sponsors who might be more involved in some cases, in terms of keeping tabs on their plan, It's not so easy for a plan sponsor to be able to identify that stuff on their own. They're typically running their day-to-day business and not, focused on running a qualified plan. So it's important to make sure that those clients have service providers that are qualified and up to date and diligent about getting things done. Plan sponsor discretion. We'll talk over the next couple of slides, I think, of choices that plan sponsors have in terms of designing their retirement plan program. And again, all of this is detailed, documented in a written plan document and in the SPT. Lucy, I think we have our next question, right?
Yes, the second poll will be launching right now.
So this one is, who or what entities can require plan documents to be amended?
This poll will be open for another 15 seconds for anyone who hasn't selected an answer yet.
Okay.
The poll is now closed. Rich, you may continue.
Okay. And I don't know why that pops out of the presentation mode when you close the poll, but it does. Okay, so the answer to that last question is it was D, which was all. So everybody who selected D, I think, got the right answer. So we'll talk next about eligibility. Is one of the features that plan sponsors can have some flexibility on. And there's a basic requirement in the law that says you can make certain participants wait up to 2 years of service before they're eligible for, let's say, a profit-sharing type of a plan or a defined benefit type of plan, or you can make them wait 1 year if it's salary deferral 401k type plan. You can put in a requirement that participants have to be at least age 21. You could also have a requirement that says, hey, they work 1,000 hours a year before they're eligible. Now, with that third bullet there, I want to be a little careful because there was change in law that basically is going to allow what we call LTPT, long-term part-time employees, to participate in plans, even though they never meet the 1,000-hour requirement. And a couple of things that kind of sets a 3-year clock running. There is, just so you know, some proposed legislation in Secure 2.0, which passed the House to reduce that to a 2-year period and so on and so forth. So there will be undoubtedly some changes there. But those are the general requirements that we outlined in this slide. Right, and you can see I've got some detail here on the new part-time employee coverage in the bottom half of this slide. But again, as I just said, Secure 2.0 has already passed the House. The Senate version, Senate has their own version of the bill. By the way, we think that is going to pass in some form this year. My guess would be that's going to be kind of a year-end event. But there's definitely going to be some tweaks and some reconciliation between the House and Senate versions of the Secure 2.0 bill. So we don't know yet what the final versions are going to be, but by and large, most of the provisions, all the provisions in there are beneficial to plan sponsors and adopting employers, adopting employers as well as to participants. So lots of really good stuff there. The one thing I've said is, how are they going to pay for all this stuff? Because a lot of what's in Secure 2.0 provides additional tax breaks or tax credits for forming a new plan. things of that nature, which cost the government money in the short run because, if plan sponsors and or participants are making higher levels of contributions that are tax deductible, that's less tax revenue in the short run for the government. So it's going to be interesting how those two different bills are going to be reconciled. But I think, there's pretty big bipartisan support for Secure 2.0. Okay, so let's talk a little bit more about eligibility. We get this kind of question all the time. Can I exclude folks from, or employees from my qualified plan? The answer is yes. And there's a couple of basic requirements. If they're in a union, if there's staff members or union employees, they can be excluded from a plan that would otherwise cover, let's say, non-union employees of an employer, typically the management type employees, so on and so forth. And typically the union has negotiated to have a plan of their own for those collectively bargained or union employees. So those are some of the clear exclusions. The other ones I mentioned earlier, the age and the service requirement, those are other statutory exclusions. But even though these exclusions are available, you don't have to necessarily recognize them, right? I mean, if union employees didn't have a separate plan, it is possible to cover them in a regular qualified plan that covers the management employees. In theory, you could cover non-resident aliens also if you wanted to. And then there's other ways of excluding employees. There are things called class exclusions. And, where a certain category of employee is not eligible to participate in the plan. So that's a voluntary employer adopted feature, but that is subject to some very, very strict operational compliance testing metrics that have to go into it. It's not like you could have an owner or partners in a business say, hey, we're covered, but nobody else is covered. That wouldn't meet the various non-discrimination tests. But it is definitely possible, and we see it, I wouldn't say all the time, but we see it relatively frequently where in certain situations where it may make sense to do that kind of a thing. But again, it's just, additional testing that would need to be done, at that point in time. So in terms of other flexibilities at the plan sponsor level, contribution types and amounts, right? You can have different formulas to allocate, let's say, a profit sharing type contribution in a plan or a discretionary contribution that may go into the plan. So, typical, you can allocate contributions in proportion to salary, which means, if I get 5% of pay, then you get 5% of pay if you're otherwise eligible, and everybody gets a flat 5% of pay, or whatever the contribution amount is. Permitted disparity, we used to, years ago, call that Social Security integration. And that's basically a method where you give certain people a higher level of contribution. For example, if they're earning above the Social Security taxable wage base, you're legally permitted to give them a higher level of contribution. And the thinking behind that was, well, that those salaries in excess of the taxable wage base are not eligible for Social Security benefits, right? Those participants don't get Social Security income on that level of comp. So your private pension plan, 401k, profit sharing, whatever, could permit a little bit of a skewing of contributions to the more highly paid groups. And then there are things called rate groups or cross-testing. I typically call those new comparability type of plans, where simplistically what you do is you test the benefits that you're giving folks as if it were a defined benefit plan. I think it's worth spending 30 seconds on that, but basically you could say, I'm making up the numbers a little bit today, but let's say you had a 55-year-old employee and you wanted to give them 10% of pay. That could be deemed to be comparable, that's why I call it new comparability, to a 25-year-old employee who's only getting, let's say, 3% of pay, right? And the whole premise is, well, the 25-year-old has 40 years to go till the normal retirement date. The 55-year-old only has 10 years to go. So, 10 years to go and 10% of pay, and put a rate of interest on it that's mandated in the law, accumulates to a certain amount of money. And that amount of money as a percent of their pay is similar to a 3% of pay contribution for 40 years for that younger employee. So it's a way, rate group testing, new comparability cross testing is all a way to skew benefits, to an older portion of the workforce. And that's pretty common in plan design these days to do that. Other types of flexibilities within the plan vesting. There are certain, we touched on it earlier, certain maximum vesting periods that are permitted. You can always go shorter on it. It's not uncommon for us to see, let's say, a 6-year graded vesting schedule for a profit sharing contribution. And while at the same time, the matching contribution may be 100% immediately vested. And, plan sponsors do that kind of a thing for a variety of reasons. One of them might be competitive reasons, right? If they're competing for talent or staff with other employers in their area, that maybe, it's typical to do 100% immediate vesting on a match for other employers. So, hey, we'll give our employees that, but we're doing a profit sharing contribution in addition to that, and we feel it's fair to grade the vesting out over a longer period of time because for a lot of reasons, maybe our competition doesn't provide profit sharing at all. So that's just one example. Safe harbors, again, plans can be designed with safe harbor, either matching type contributions or across the board type contributions in order to avoid non-discrimination testing on 401k salary deferrals and or 401k match. So the safe harbors are pretty popular. And again, the rules and the law state certain requirements that need to be met for that safe harbor to apply to get that client or that plan sponsor out of testing. Loans, most plans that I see allow for loans. There's statutory maximums and timeframes in which they've got to be repaid. Those are the outliers, right? You can either not allow loans or allow loans for limited purposes, right? Not much different from a hardship. I've seen some plans, not many, that say, hey, if you have a medical need or necessity, you can take a loan for that purpose, but maybe they don't allow loans for other purposes. We see a lot of plans that have a loan, general loan available for any purpose, but other plans may allow for loans for purchase of a principal residence. And typically, the limitation on what you can take is the same, $50,000 max, but you can extend the loan repayments as a participant up to 15 years under that scenario. So we definitely see differences in plan design that hit a lot of these bullets here. Other types of flexibilities, and some of these apply more to a defined benefit plan, lump sums. Are they available or not available, or is it just an annuity or monthly or periodic payment available from the DB plan? Periodic payments, by the way, could be allowed in defined contribution plans too, and we do see a lot of that. I mentioned this next thing earlier. Vesting schedules allowed on certain types of employer contributions, and they can be different. Distribution options. There are certain ways of putting legally permissible in service, meaning I'm still employed, still working, and still accruing benefits, but certain plans, both DB and DC, can have certain in-service distribution features put into the plan. Typical 401k would allow in-service at age 59 and a half. That's the most common we see there. And again, leaving employment, right, attaining normal retirement age, or in the DB world, by the way, you can have an in-service distribution option as early as age, used to be 62, it's now age 60. So, I'm sorry, it's actually, I think it's 60, and maybe they're looking to make it 59 and a half in one of the Secure Act, Secure 2.0 provisions to put it on par with 401k. On the next slide, again, pop out of presentation mode. Let me go back. And there we go. All right. this is talking about loan provisions, again, which we touched on. Participants can be permitted to self-direct investments. Very, very common, obviously, in 401k plans. Many years ago, we saw more plans where, and more so in the profit-sharing world, or when clients had money purchase type plans, right? It was not uncommon many years ago to have the assets invested on a pooled basis with no choice at the participant level. We still see a few of those plans exist in that format, not very many, but self-directing investments is definitely something that is more prevalent today. Insurance could be allowed as a plan investment, so to speak, or as a way of enabling participants to purchase insured death benefits that would be tax-free to their beneficiary if they were to die while that policy is in place. We see that much more in the micro plan market, where there's an owner an owner and a spouse, or maybe a couple of partners, and not a lot of regular rank and file employees. Not unusual to see that, but by and large, that's not really a trend across the industry. And employer securities, last bullet here, is something we see quite a bit of, where clients will have publicly traded securities in their plan as an investment option. And we even see plans with thinly traded or non-publicly traded securities in their plan also. Bunch of hoops you got to jump through to get there and make that viable, but it's definitely possible to do that kind of stuff. Lizzie, I don't know, is this our third question?
Yes, so this is going to be the third poll, and also in the subject of just time and to make sure that we complete all 4 polls to make sure everyone gets their credit that they signed up for. I'm going to launch the third one, and then directly after, I'm going to launch the fourth to make sure we get them both in on time. So I'm going to launch the third one right now.
Okay. This one is just pretty easy. I'm going to say easy only because it's true or false, right? Plan sponsors can exclude certain employees from plan participation within certain limitations. Is that true or false? And Lizzie, you'll let us know when that's closing. That should be pretty easy for folks to do that one.
Yep, I'm going to give it another 15 seconds for this poll for whoever hasn't answered yet.
Okay.
All right, this poll is now closed, and I'm going to launch the fourth poll for you guys to answer.
Okay, and by the way, the answer to that question was true, I believe, if I'm keeping pace with it, right? Because I had talked about certain exclusions, statutory as well as other ones that could be implemented in the plan. So this question, I have to jump ahead, right? Yeah, this one is which of the following types of business can establish a 401k plan? Lizzie, did you launch that one already?
Yes, we have about 10 seconds on the clock for whoever did not answer yet.
Okay. It might be a little bit tougher to answer since I don't think we covered the material for that yet, but that's all right.
Yep, as long as you guys answer, you'll receive the credit, whether it's incorrect or correct.
Okay. All right.
And then the fourth poll has now closed, and Rich, you can continue.
All right, I'm going to continue with the presentation, and I think we'll get it all in here. Who initiates plan amendments? Again, we covered some of this earlier. A plan sponsor, or obviously if it's required by the Internal Revenue Service. In order for the amendments to be valid, right, it's got to be signed by the plan sponsor. Can't tell you how many times we see plans coming to us from other providers where the client can show us an unsigned copy of the amendment, but it's critical to have a signed, documented amendment on file and kept with your plan records. Uh, we used to see more of the determination letter process where, you'd amend a plan and submit it to the IRS and see if they would accept it. We see less and less of that these days. In a lot of cases, the IRS produces what are called LRMs, and that's really a listing of required modifications, and they'll actually go through the law and spit back in a kind of a pro forma amendment. I'm a little leery of saying that for any of the attorneys on the phone, but they'll give you the legal language that could be folded into an amendment, but typically a service provider will then take that and modify it to a little bit, or maybe not. Maybe that's okay as an interim amendment to just get it done and take care of the fine points at a later date, but not unusual for that to happen. And then, as I mentioned earlier, SPDs, well, a variant of an SPD is an SMM, a summary of material modification, and that's just typically a very short document explaining what that amendment was, and there are certain deadlines that are recognized to give that to plan participants. So again, in this section summary, certain language is required in plan docs. Plan provisions can be optional, some are mandatory, and it's critical to keep complete records of what you've done, so you can prove that on audit or whenever that restatement of that plan document comes up, that things are in good order. Obviously that operationally you've been administering the plan in accordance with the plan document and amendments. So next we're going to talk about the types of plans that are out there. And I think a lot of folks on this webinar recognize all of these pretty much. Profit sharing plans, right? Those are discretionary contribution type plans. Where the plan sponsor can put in anywhere from 0 to, maybe as much as 25% of salary in a given period for the benefit of the participants. And that's subject to tax deduction limitations. Is also coordination of deduction limits if you have more than just a profit sharing plan. Money purchase plans, they were, we don't see very many of them now. There's still a few around, but typically they're hard-coded with a required contribution. Typically it would be a 10% money purchase plan that was usually paired with a discretionary up to 15% of pay profit sharing plan that gave the employer the ability to go from 10 to 25% of pay between the two different plans. But we see fewer and fewer money purchase plans these days, and some of the rules on profit sharing have been liberalized over the years. 401k, we probably should have had that at the top of the list because that's the most common type plan we see out there today. Safe harbor 401ks, obviously a big component today of the types of plans we see. Auto enrollment safe harbor plans, where participants are automatically enrolled. I could spend probably an hour on the effectiveness of that, which is actually a pretty effective provision to have in a plan. Defined benefit plans, we still, as an organization, manage a significant number of defined benefit plans. So notwithstanding the commentary in the industry that DB plans are going away or don't exist, that's not really true. We see a lot of legacy, I call them legacy DB plans that are providing significant benefits to employees. But we also see, we've seen a resurgence over the last 5 years or 8 years of small market DB plans. And again, I won't go into all of that today, but a lot of that is driven by the fact that you can put away a lot of money on a tax deferred basis in a defined benefit plan, and it has much higher, I'll call it deductibility and contribution type limits for certain classes of employees. And 403B is really, kind of a plan that's similar in many ways to a 401k, and typically, we see it in the not-for-profit sector. And I guess there's one on here, maybe it comes up later in the slides, governmental plans. They're not eligible to do 401k plans, but they have a counterpart, which is called a 457B plan, which we see in the governmental arena. So, profit sharing eligibility, Again, any employer pretty much can adopt it. Sole proprietors, Subchapter S, Subchapter C corps, partnerships, nonprofits, and governmental entities. Typically in the governmental space, they call them 401A plans, but that's kind of minutia. That's just yet another code section of ERISA that's out there. Again, profit sharing plans, 25% of comp is the maximum employer tax deduction limit. Participant limitations overall in a profit sharing or profit sharing 401k combo plan. So less than 100% of pay or 61,000 is the maximum amount a participant could get between their own contributions, their own salary deferrals, and or employer contributions and or after-tax contributions. Some plans, we actually have quite a few plans that permit after-tax contributions. Catch-up contributions, I'm not sure why we say not applicable there, but maybe that word needs to come out, but catch-ups are permitted in 401k plans. I guess it's really not a separate definitional type of, it really fits within that $61,000 max contribution limitation for the participants. That's probably why we say not applicable there. And again, different vesting schedules can apply to profit sharing arrangements. So this piece of it, I think, is interesting. This was put into place by the Secure Act. It used to be that plans, a new plan had to be adopted no later than, let's assume a calendar year taxpayer, right? So to adopt a plan for a given year, that employer would have had to adopt it and sign the plan document and so on and so forth no later than the end of the plan year in which that plan was effective. So this was changed to basically say employers can now retroactively adopt a plan for the preceding tax year. So I'll run through, a couple of examples, right? If I'm a regular C corporation, right? My tax filing deadline is March 15th, or was March 15th of 2022. But conceivably, that employer, plan sponsor, could have adopted a plan for the 2021 calendar year on a retroactive basis. Now, if that same employer had applied for a 6-month extension of time to file their tax return, well, guess what? They could have gone out to September 15th. So anybody on extension who's a C Corp could go back and put in a plan for 2021. And you might say, well, why would they want to do that? That year has come and gone. Well, it's really, really valuable to do that for typically we see smaller plan sponsors, closely held corporations who, may at this juncture say, wow, our corporation, our company made a lot of money for last year, now that we're getting into the tax payment side of it or tax filing side of it. And it's not uncommon to see those businesses say, hey, you know what? It makes sense for us to have a defined benefit plan for last year. So they still have time this year to go back and adopt one retro to last year. You can't really adopt a 401k retroactively, but you could certainly adopt a profit sharing or defined benefit plan retroactive to 2021. And again, LLPs or partnerships, they would have had an April 15th tax filing deadline. Again, they can do the same 6-month extension of time that will take them out to October 15th to retro adopt a plan for the preceding calendar year. So that's kind of a cool thing, and it really was done under the heading of encouraging new plan formation. And that really has been, I would say, the mission of Congress and the current administration as well as the prior administration to increase retirement plan coverage in the U.S. Because not every employee has access to a qualified plan. So, I thought that was kind of interesting that they put that flexibility in. And, as a service provider, I'm going to wrap up in a minute here for anybody who's still on the call. But it's kind of interesting because we used to do the year-end scramble where we'd have certain employers saying, "Oh, we got to get a plan in for this year, and it's already December 20th, and how are we going to design it and get it done and produce a plan document and get that executed?" And now there's a lot of pressure that's taken off, and it gives those employers more time to figure out their tax situation for that year, and it lets them to retroactively adopt the plan. So kind of a cool feature. So with that, we're going to end for today's presentation. I hope you took some useful information away. Lizzie, do you want to comment on copies of the material and things like that?
Yes, so I'd just like to thank everyone who attended today's webinar, and thank you, Rich, for your time. Any questions that were sent to us that we did not get to today, we're going to follow up with you separately. And just as a reminder to please complete the survey questions that will pop up on your screen in just a minute. And you will all get a copy of today's webinar in an email tomorrow. And everyone have a great rest of your day.
Thank you.